Welcome back to the deep dive. Our mission here is to take a dense stack of research and professional guidance that defines a specific field and hand you the synthesized knowledge.
That's it.
Today, we are cracking the vault on client profiling for accident and sickness insurance. A&S. This deep dive is all about understanding what we call the risk architect.
That's a great way to put it. When you apply for disability or critical illness or even long-term care coverage, the insurance professional isn't just, looking at your financial statement.
Right.
They are building a holistic, multi-layered profile of you. Our goal today is to walk you through exactly how they construct this comprehensive picture, drawing from established best practices and guidance that, define risk across all aspects of your life.
We often think of insurance in terms of assets, your house, your car, your business, but A&S is totally different. It's an exhaustive assessment of your future earning potential and, really, your physical fragility.
And it covers three major pillars: your personal situation, your financial situation, so income and expenses, and your existing insurance situation.
Critically, we start with the personal. Why is that?
Well, we have to. Because the personal factors, your age, your gender, your health, even what you do on the weekends, that's the foundation. It's the foundation upon which all the financial need and risk probability are calculated.
So it's not just about the numbers.
Not at all. These factors directly determine the likelihood of a claim and, I'd say more importantly, the potential duration of that claim. And that's the key determinant of cost at the end of the day.
Okay, let's jump right into that personal snapshot then. Age and gender feel like the fundamental starting points. But the way they interact when underwriting A&S can be, kind of counterintuitive.
They absolutely are. Age is a pretty straightforward factor in the risk model. I mean, the older you are, the higher the statistical risk of illness or disability today. That makes sense.
Sure.
But for underwriters, the more crucial aspect is actually the number of years between now and your planned retirement. The timeline.
The timeline. If a 30-year-old is permanently disabled, the insurer is now facing decades of potential benefit payments. That extended liability, it directly inflates the cost of protection, even if that 30-year-old's immediate health risk is lower than a 55-year-old's.
So it's not just the probability of something happening, but the sheer length of the exposure if it does.
Exactly. And then you introduce gender, which creates this really interesting dynamic because it forces us to contrast two totally distinct risk concepts: mortality and morbidity.
Okay, break that down for us. Mortality versus morbidity.
So when you look at mortality, that's just life expectancy. Statistics consistently show that women, on average, live longer than men of the same age. Now, that longevity is a benefit for life insurance. It might even lead to slightly lower premiums.
But for long-term care, or LTC, it becomes a major cost factor.
It does. It feels like a paradox, doesn't it?
It really does.
Right.
Why would living longer be considered a negative risk for LTC? It's all about the financial exposure. If a woman is statistically expected to live, say, 3, 4, or even 5 years longer than a man, and she has an event that requires expensive, round-the-clock care,
This bill just keeps running for longer.
the cumulative cost of that care is just anticipated to be significantly greater, simply because the insurer is on the hook for a longer period of time.
So the good news of longevity translates directly into higher anticipated care costs for the underwriter,
Precisely. And the dynamics shift again when we look at morbidity.
which is the likelihood of getting sick.
Yes, the likelihood of incurring a disability or a chronic illness. The statistical evidence shows that women generally have a higher likelihood of incurring a disability than men of the same age, even while they maintain that longer life expectancy.
Wow.
And these are the critical statistical nuances that define the risk profile before we even look at a single dollar of your income.
Okay, so let's unpack this next layer, because this is where the profile gets fascinatingly granular. We've covered the immutable facts, age, and gender. Now we get to what you choose to do, your avocations, your weekend hobbies.
Right. Risk is not contained by the walls of your office. A client's activities outside of earning a living give crucial insight into the likelihood of a major injury claim.
And underwriters categorize these hobbies.
They often do, into 3 pretty clear tiers to assess how much extra risk you're bringing to the table.
Let's start with what seems like the benign end, the sedentary tier. This is, watching TV, reading, playing chess. Low risk for injury, but the source material we looked at points out a kind of hidden morbidity factor here.
And here's the irony, right?
Yeah.
While the risk of, breaking your neck playing chess is basically 0,
Let's hope.
a deeply sedentary lifestyle often leads to long-term health problems, We're talking obesity, cardiovascular disease, adult-onset diabetes. A sedentary professional with a desk job might look low risk for an accidental injury.
But the underwriter sees something else.
The underwriter sees a magnified long-term health risk, one that could lead to a massive critical illness or disability claim way down the road. They're looking beyond the obvious immediate danger.
That's a really sophisticated way to look at risk. Okay, so contrast that with the moderate tier. Regular walks, recreational cycling, golf, non-contact hockey. These are generally a net positive for your insurability.
Yes, exactly. They suggest an active, balanced lifestyle that, combats the health risks inherent in modern life. The underwriter sees that as mitigation.
But then we get to the third category.
And then we arrive at the third category, yes. The extreme or high-risk avocations. Rugby, skydiving, mountain climbing, maybe Formula One racing.
Okay, so these clients are clearly at a much higher risk of injury and permanent disability.
Yeah.
What for the listener who loves, say, high-altitude trekking on their vacation?
The what is that these activities can render a client totally uninsurable for disability or long-term care coverage. Full stop.
Wow.
And if they are insurable, the policy will almost certainly be issued with a specific exclusion endorsement.
Meaning?
Meaning the policy might state, in bold letters, that if an injury occurs while you're participating in a defined high-risk activity, let's say organized rugby, the claim will be declined, period.
Right.
Regardless of how much premium you've paid.
So the underwriter is basically saying, we will cover you for the risks of life.
But not for the risks you deliberately go out and invite. It makes the cost-benefit analysis very clear for the client. The frequency and severity of claims from those hobbies just make it financially impossible for the insurer without a huge premium or a specific exclusion.
Let's shift now from individual activities to family structure. Yeah. How does marital status and having dependents fundamentally change the calculation of income replacement needed?
This moves us into the financial side of the assessment, and marital status provides an immediate buffer. A single client, like Henry in our example, has a simple situation financially, but they lack that dual income safety net or the immediate caregiver support a partner provides.
Their needs are purely about replacing their own lost income.
100%.
Let's run those numbers to really show the difference a second income makes. If Henri, who is single, earns $60,000 a year, and the goal is to replace 60% of his income, he needs $3,000 a month in disability insurance. That's assuming he has zero other income sources.
It's a pure, unmitigated need. Now compare that to Jacques and Marie. They're married. They each earn $60,000 for a combined family income of $120,000 to $20,000.
And their goal is also 60% replacement, which is $6,000 a month for the family.
Right. But if Jacques becomes disabled, Marie is still earning her full $5,000 a month.
So the family's actual shortfall is only $1,000 a month.
It's a dramatic reduction in risk exposure just because a second earner exists. Now, Jacques might still choose to insure for more than $1,000 to cover extra caregiving costs or to allow Marie to reduce her work hours, but the fundamental need for income replacement is substantially lower than Henri's.
That's why that marital status question is so critical. It adjusts the entire financial requirement downward.
It does, but then you have to factor in dependence, which pulls the need for coverage right back up, and often substantially.
And we aren't just talking about young children, are we?
No, not at all. Dependents are a major amplifier. You have to consider situations where the spouse themselves is aging or has a disability, making them reliant on the policy income. Or what about kids with special needs who might need support for much longer?
And the conversation can get even more complex when we look at extended family.
Exactly. We often see clients who are active caregivers for or are financially responsible for aging parents, grandparents, siblings. These obligations don't just disappear because the client gets disabled. They have to be met.
Which requires a much higher A&S benefit amount.
Absolutely. And on top of that, the insurance professional has to know the provincial laws around matrimonial property and ongoing support. If a client is divorced, they may have court-mandated payments to an ex-spouse or kids that have to be maintained. Disability doesn't just negate that legal requirement.
That's a sophisticated legal layer to the profile that goes way beyond simple arithmetic. It connects the personal, financial, and legal worlds.
It really does. It reinforces the need for that holistic assessment.
Okay, here's where it gets really interesting for disability coverage specifically. Occupation. This is the single most critical factor in determining the type of coverage you can get, the benefits you receive, and of course the cost.
It is the ultimate disability litmus test. Less so for critical illness or LTC, like you said, but for disability, it's everything. Underwriters classify every job based on the inherent risk of injury or ailment.
And the highest classification, the lowest risk that's reserved for.
White-collar professionals, doctors, lawyers, senior managers whose job duties are administrative or advisory. They work in controlled, safe environments.
And that low-risk status qualifies them for what's really the gold standard of coverage. The own occupation definition of disability. Can you clarify that distinction? It's so important.
It is crucial. An own occupation policy means that if you, as a specialized surgeon, cannot perform the specific duties of a surgeon, you are considered disabled. Even if you could theoretically go work as a grocery store manager.
You're disabled from your own job.
From your own specialized job. Now, for higher risk occupations, say a construction foreman or a skilled mechanic, they're typically pushed to an any occupation definition. This means you are only considered disabled if you cannot perform the duties of any job for which you are reasonably suited by education, training, or experience.
The difference in coverage is just monumental.
Yeah.
And it's dictated almost entirely by your job title.
Pretty much. But it's not just your current job. Your entire work history is scrutinized. And this gets to a really interesting point. Your past job in a dangerous environment might be dictating your policy structure today, even if you've been safe in an office for a decade.
Why is that? How can a job from 10 years ago still matter?
It's because of something called occupational latency. Underwriters understand that certain environments, mining, manufacturing, working with noxious chemicals, they expose you to hazards that might not show up for years, sometimes decades.
Like lung damage or asbestos exposure.
Exactly. Or hearing loss. Even if you're a senior manager now, that decade you spent in the mine represents a postponed physical ailment risk that is factored into your profile today. The insurer is looking for evidence of pre-existing risk exposure, even if the symptoms haven't shown up yet.
So frequent job changes, especially between fields with really different risks, that makes the underwriter nervous.
It does. Stability and clear risk classification are highly valued, and future plans matter too. If you plan to retire in 2 years, the need for benefits is short. If you plan to change jobs next year to something physically demanding, that requires an immediate reassessment.
And benefits are ideally payable right up to your target retirement date.
That's the goal.
Okay, we've reached the final cornerstone of the personal profile. Health. Your health, and maybe surprisingly for some, the health of your immediate family, are absolutely critical for all A&S insurance types.
This section is the primary indicator of potential future claims. For your personal health, any past disability claims, surgeries, chronic conditions, they are major underwriting considerations. The medical questionnaire is exhaustive. It requires every detail.
The nature of the injury, its duration, lingering effects.
All of it. And a negative medical history can easily lead to severe premium loadings, specific policy exclusions, or in the worst cases, just an outright denial of coverage.
This is where the family history comes in, which can feel a little intrusive, but it clearly informs the risk model.
It's of almost equal interest, especially the health of your parents and your siblings. We're looking for inherited risks that might flag future critical illness or long-term care claims.
For instance,
Well, for example, if a client's parents or grandparents were diagnosed with adult-onset type 2 diabetes, the client carries a higher inherent risk. Similarly, a strong history of breast or colon cancer in immediate family members will likely lead to restrictions or even a decline in critical illness or LTC coverage for that client.
and this brings us back to that longevity paradox we discussed earlier, but now in the context of family history.
It's a key detail to reiterate. If your family has a strong history of living into their late 90s, that's great for life insurance. It suggests lower mortality risk.
But for critical illness and long-term care.
For CI and LTC, longevity is a negative. The longer your family lives, the greater the statistical probability that you will live long enough to suffer a debilitating event, making a claim on that LTC policy more likely. And that claim will be larger and longer.
That completely reframes the definition of a good health history, depending on the policy type you're looking for.
It requires a very nuanced interpretation. And then finally, we look at how your lifestyle and retirement goals introduce geographic risk.
Tell us more about that. How does the quality of your retirement impact your current insurance needs?
Well, if a client anticipates an extensive, active retirement, lots of travel, maybe moving to a different climate, there's an increased need for robust CI and LTC coverage. A debilitating event like a stroke might require specialized home adaptations or vehicle controls, and those costs are magnified if the client isn't living a sedentary lifestyle.
And the plan to live abroad, even if it's just being a snowbird for Florida winters, that becomes a serious coverage issue.
A huge issue. And what's fascinating here is the potential gap in coverage. Health costs in foreign jurisdictions can be dramatically higher than in Canada, for instance, and they might not be fully covered by provincial insurance plans.
Right.
So if you suffer a major illness or require long-term care while living abroad, your domestic A&S policy may be restricted, leaving you personally responsible for, exorbitant bills. That client needs supplemental travel, health, or specific international LTC policies to bridge that financial vulnerability.
What a phenomenal look into the risk architect's mind. We started with what seems like a basic profile form, and we ended up realizing it's a deep, continuous risk assessment. It weaves together statistical data, your weekend habits, the legal obligations from your divorce, and the health history of your grandparents.
And the final relevance for you, the learner, is empowerment. Understanding these factors gives you the ability to strategically manage the variables you can control, like your lifestyle, your work environment, and it allows you to proactively seek coverage that specifically addresses the risks you cannot control,
It moves you from being a passive applicant.
to an informed participant in building your own financial resilience.
Which leaves us with a final provocative thought for you to mull over. You may be paying the lowest possible premium for your disability coverage today because of your high classification white-collar job. But if that low premium relies on an any occupation definition of disability, is that discounted rate worth the risk? That you could be forced to perform a simpler, lower-paying job one entirely beneath your specialized experience, just to avoid being classified as not disabled?
It's definitely something to consider as you examine the small print on your policies.
That's it for this deep dive. We'll talk to you next time.